In our strategy, we operate inside a five-phase macro framework. We are not predicting tops or bottoms. We focus on sequencing, probabilities, and how risk builds across the cycle. Valuations are often treated like timing tools. That usually leads to frustration. What matters more is how valuations change the system's tolerance for mistakes. This episode is based on a Builder's Lens article explaining the Buffett Indicator, also known as market capitalization relative to GDP. The original piece frames it as a risk lens, not a forecast. That is exactly how we use it. At its core, the Buffett Indicator compares the value of the stock market to the size of the economy supporting it. It asks whether asset prices are growing faster than the income base beneath them. Companies ultimately earn from real economic activity. When market value rises much faster than GDP, future returns tend to compress, and downside sensitivity increases. This indicator does not tell us when markets will fall. It does not cause crashes, and it does not override liquidity, credit, or policy conditions. A common mistake is assuming high readings mean an immediate decline. History shows valuations can stay elevated for long periods when liquidity remains supportive. In our strategy, this is a valuation structure signal. It sits above short-term price action, and it interacts with liquidity, credit, and growth expectations. Elevated valuations require favorable conditions to persist. Growth expectations must stay high, credit must remain available, or policy must continue to support asset prices. This signal behaves differently depending on the phase. Its meaning changes across the cycle, so we always interpret it in context, not in isolation. After major resets, valuations are compressed. The indicator is low and rising. That environment tends to support stronger forward returns. During late cycle melt-ups, asset prices can rise faster than economic output. High readings here do not cause declines. They amplify the impact when conditions change. As growth expectations soften or credit tightens, elevated valuations become fragile. Markets can stall even without an obvious crisis. When forced selling appears, valuation compression accelerates. The indicator falls not because GDP improves, but because asset prices reset. This is where the indicator becomes useful again. Lower valuations combined with improving liquidity create long-term opportunity. Following a prolonged liquidity-driven expansion, the Buffett Indicator remains elevated historically. This does not imply an imminent crash. It implies higher sensitivity to shocks. High valuation environments reduce the margin for error. They increase reliance on liquidity and credit remaining supportive, and they raise the cost of being wrong late in the cycle. If this kind of framework-based breakdown is useful, subscribing helps you stay oriented as conditions change. Each episode builds on the same system, so you are not constantly relearning the cycle from scratch. Valuations alone do not trigger de-risking. They do not override confirmation requirements, and they are never used as timing tools. Quick note before we close, this is educational macro commentary only. It is not financial advice. The Buffett Indicator does not tell us what happens next. It tells us how much room for error the system has. Late in the cycle, that distinction matters. We do not need to be early. We just cannot afford to be late.